We did a little tour around the world, but we haven't talked about the big market, U.S. You mentioned earlier when we had a conversation about new developments in the States.
Sure. So I just came back from 3-week road tour with Shenzhen Stock Exchange promoting the upcoming Shenzhen Connect. And there are two really key sectors that we had significant coverage on. One was the passive ETF investors. The other segment is really more active investors, active asset managers. And overlaying that are essentially the pension funds, insurance schemes, as well as the ERISA funds and US 40 Act funds. Generally, there seems to be very, very clear divide between the active side versus the passive ETF side in terms of what investors are now beginning to look at. And overlaying that is the Department of Labor's review of ERISA funds eligibility for ETF to be eligible for investment through the U.S. retirement scheme. Essentially, by the way, ERISA, for those of you who may not be familiar with, it's the U.S. Employee Retirement Income Securities Act, which was introduced in 1970s, which essentially oversees the all retirement pension scheme allocations by U.S. Employers or employees. One of the key things that came out was essentially the cost transparency issues. And Department of Labor was very, very concerned and looked at on a number of different platforms where the transparency disclosure on the fee structures and what ETF as a new consideration brings into the table vis-a-vis the traditional mutual funds, which tends to be a little bit more opaque. And arguably, the mutual fund guys will say, well, the open-ended open-ended mutual funds have just as much of a transparency in fee schemes. But this is a fundamental change whenever we spoke about Chinese market and Asia market investment, and as it relates to emerging market exposure by the retirement schemes, every single meeting came out, the comparison between now, more transparency on fee structures, more streamlined, more essentially what you consider commoditizing the fee structures so that investors have a better choice. Investors are more aware of what they're investing in rather than the traditional model. And this is a big movement that we felt, both Shanghai Shenzhen felt that this is going to fundamentally change the structure of how U.S. investors invest into ETFs. And therefore, once they continue to move in that direction, very likely it'll impact Asia in a very big way. Not only the current offered U.S. ETFs that are offered in the Asia time zone, the investors will have to look at that, but also the sovereigns as well as the retirement funds here in Asia will also have to look at similar type structures. So we actually foresee a number of different perhaps regulatory communication going on with U.S. regulators and Asian regulators more on this front.